Strategic Financial Management. Table of Content. Introduction. Chapter 1. Introduction to Strategic Financial Management. Chapter 2. Principles of Financial Strategy. Chapter 3. Financial Analysis for Strategic Decision-Making. Chapter 4. Capital Budgeting and Strategic Planning. Chapter 5. Risk and Uncertainty in Investment. Chapter 6. Mergers, Acquisitions, and Divestitures. Chapter 7. Cost of Capital and Capital Structure. Chapter 8. Sources of Finance. Chapter 9. Dividend Policy and Shareholder Value. Chapter 10. Managing Financial Risk. Chapter 11. Corporate Governance and Ethics. Chapter 12. International Financial Management. Chapter 13. Strategic Financial Planning and Forecasting. Chapter 14. Performance Measurement and Management. Chapter 15. Financial Technology and Innovation. Chapter 16. Strategic Financial Decision-Making in Practice. Chapter 17. Emerging Trends in Strategic Financial Management. Chapter 18. Conclusion and Future Outlook. Introduction. Strategic financial management is the cornerstone of modern business success, serving as both a compass and a toolkit for organizations navigating the complex world of finance. In an era defined by rapid technological advancements, global interconnectedness, and evolving stakeholder expectations, the ability to make informed strategic financial decisions is more critical than ever. This book aims to provide a comprehensive roadmap for financial leaders, managers, and students to understand, analyze, and apply the principles of strategic financial management effectively. The journey begins with foundational concepts, including financial analysis, capital structure, and risk management, and progresses toward advanced topics such as mergers and acquisitions, international finance, FinTech innovation, and emerging trends shaping the future of the discipline. Each chapter integrates theoretical frameworks with practical applications, real-world examples, and actionable insights, equipping readers with the knowledge and tools to drive sustainable value creation. This book emphasizes the integration of financial strategy with organizational goals, highlighting the importance of performance measurement, governance, ethics, and data-driven decision-making. By blending quantitative rigor with strategic foresight, it demonstrates how financial management transcends traditional accounting and reporting, becoming a dynamic driver of growth, resilience, and competitive advantage. Whether you are a seasoned finance professional, an aspiring leader, or a student seeking a deep understanding of corporate finance strategy, this book offers a structured, insightful, and practical guide. It is designed not just to inform, but to inspire critical thinking, strategic planning, and innovative approaches to financial decision-making in an increasingly complex business landscape. Chapter 1. Introduction to Strategic Financial Management. 1.1 Overview. Strategic Financial Management, SFM, is the practice of aligning financial decision-making with an organization's long-term objectives. It goes beyond day-to-day financial operations, focusing instead on creating sustainable value and ensuring that financial resources are optimally deployed to achieve competitive advantage. While traditional financial management focuses on budgeting, accounting, and reporting, SFM integrates financial decisions with strategy, risk management, and corporate vision. It addresses questions such as: how do we fund growth initiatives? How do we evaluate investments under uncertainty? What capital structure maximizes shareholder wealth while minimizing risk? SFM requires a forward-looking approach, anticipating future scenarios and preparing for financial challenges and opportunities. 1.2 Importance of Strategic Financial Management. The financial environment is dynamic, influenced by market volatility, globalization, technological disruption, and regulatory changes. In this context, SFM plays a critical role by ensuring financial sustainability, maintaining liquidity, solvency, and profitability to sustain operations and growth, optimizing capital allocation, prioritizing investments that create the highest strategic value. Managing risk, identifying, assessing, and mitigating financial risks that could derail long-term goals. Enhancing shareholder value, making decisions that align with the interests of investors and other stakeholders. Supporting strategic flexibility, ensuring access to funding for seizing emerging opportunities or navigating crises. Organizations that practice SFM effectively are more resilient and capable of adapting to external shocks. 1.3 Core Components of Strategic Financial Management. SFM is multidisciplinary and encompasses several key areas. Financial planning, establishing long-term financial goals and aligning resources to meet them. Capital budgeting, evaluating major investments and projects for their potential to generate value. Capital structure decisions, determining the optimal mix of debt and equity financing. Working capital management, ensuring efficient management of current assets and liabilities to maintain liquidity. Risk management, using financial instruments and policies to mitigate exposure to market, credit, and operational risks. Performance measurement, tracking metrics such as ROI, EVA, and free cash flow to ensure financial goals are met. 1.4 Strategic versus tactical financial management. A crucial distinction must be made between strategic and tactical financial management. Tactical financial management focuses on short-term activities such as cash management, payroll, and expense control. Strategic financial management looks at the long-term implications of financial decisions, considering factors such as market positioning, competitive advantage, and risk-return trade-offs. Both are necessary, but SFM provides the guiding framework within which tactical decisions are made. 1.5 The role of the CFO in strategic financial management. The Chief Financial Officer, CFO, plays a central role in implementing SFM. Modern CFOs act as strategic partners to the CEO and board, providing insights on capital structure and funding, recommending financing options aligned with corporate strategy. Risk strategy, advising on hedging, diversification, and contingency planning. Performance reporting, translating financial data into actionable strategic insights. Value creation, ensuring every major decision contributes to shareholder wealth. The CFO's role is no longer limited to financial stewardship, but includes influencing the overall direction of the organization. 1.6 Strategic Financial Management Framework. An effective SFM framework typically includes the following steps. Vision and mission alignment, connecting financial decisions to corporate purpose. Environmental analysis, assessing economic, industry, and competitive conditions. Goal setting, defining measurable financial objectives, e.g., revenue growth, ROE, leverage targets. Strategy formulation, designing capital allocation and financing strategies to achieve goals. Execution and control, implementing initiatives and monitoring progress. Review and adaptation, adjusting strategies based on performance and market changes. 1.7 Challenges in strategic financial management. Despite its importance, SFM faces several challenges. Uncertainty, difficulty in forecasting future economic conditions. Short-term pressures, shareholder and market demand for quarterly results can conflict with long-term value creation. Complexity, balancing multiple objectives, profitability, growth, liquidity, and risk, requires sophisticated tools. Globalization, managing currency, tax, and regulatory differences across multiple markets. Technological disruption, rapid innovation can render strategies obsolete if not regularly updated. Organizations must develop dynamic, adaptable strategies to overcome these obstacles. 1.8 Summary. Strategic financial management is the process of aligning financial decisions with an organization's strategic vision to create long-term value. It integrates financial planning, investment appraisal, capital structure optimization, risk management, and performance measurement into a cohesive framework. As businesses face increasing volatility and competition, SFM is essential for building resilience, maintaining competitiveness, and ensuring sustainable growth. Chapter 2: Principles of Financial Strategy. 2.1 Overview. Principles of financial strategy form the intellectual backbone of strategic financial management. They provide a framework for making decisions that are aligned with an organization's mission, vision, and long-term value creation goals. By understanding these principles, decision-makers can navigate complex financial environments and design strategies that balance risk and reward. 2.2 Value creation as the central objective. At the core of financial strategy lies value creation. A company's financial decisions should aim to increase the firm's overall value for its stakeholders, particularly shareholders. Shareholder wealth maximization. The ultimate financial goal is to maximize the market value of shareholders' equity. This aligns management incentives with investor interests. Economic value added (EVA), a key metric for assessing whether the company is generating returns above its cost of capital. Sustainable growth. Strategies should not only produce short-term profits, but also ensure the organization's ability to grow consistently over time. 2.3 The risk-return trade-off. Every strategic financial decision involves balancing risk and return. Risk assessment. Identifying sources of risk, market, credit, operational, and liquidity. Expected return. Estimating potential gains from investments or financing choices. Optimal risk-taking. Striving for the highest possible return for a given level of risk, or minimizing risk for a target return. Tools such as portfolio theory, beta analysis, and scenario planning help quantify and manage this trade-off. 2.4 The time value of money. Strategic financial management is inherently forward-looking, making the time value of money, TVM, a foundational concept. Present value, PV. Future cash flows must be discounted to assess their value today. Net present value, NPV. The primary criterion for evaluating investments, projects with positive NPV add value. Internal rate of return, IRR. The discount rate that makes NPV zero, used to compare investments. Understanding TVM ensures that capital is allocated to opportunities with the best long-term payoff. 2.5 Optimal capital structure. Capital structure decisions, how much debt versus equity to use, are critical to financial strategy. Trade-off theory balances tax benefits of debt against financial distress costs. Pecking order theory prefers internal financing first, then debt and equity as a last resort. Modigliani-Miller theorem provides a theoretical benchmark that capital structure is irrelevant under perfect market conditions, though real-world frictions matter. Strategic financial managers seek the structure that minimizes the weighted average cost of capital, WACC, while maintaining flexibility. 2.6 Liquidity and financial flexibility. Liquidity is the lifeblood of any organization. Without adequate liquidity, even profitable companies can fail. Working capital optimization, managing receivables, inventory, and payables efficiently. Cash reserves and credit lines, maintaining sufficient buffers to withstand shocks. Flexibility for growth, ensuring the organization can quickly fund new initiatives. A sound strategy balances liquidity needs with opportunities for reinvestment. 2.7 Alignment with corporate strategy. Financial strategy must be consistent with the broader corporate strategy. Growth strategies, expansion initiatives, organic or through M&A, must be supported by adequate financing. Competitive positioning. Financial decisions can strengthen cost leadership, differentiation, or focus strategies. Risk appetite. Aligning risk management practices with the company's tolerance for volatility and potential losses. 2.8 Ethical and governance considerations. Sound financial strategy also requires adherence to ethical and governance principles. Transparency, accurate, timely disclosure of financial information. Accountability, clear decision-making authority and responsibility. Sustainability, considering environmental, social, and governance (ESG) factors in financial decisions. Ethical lapses or poor governance can destroy value, even if financial metrics appear strong. 2.9 Summary. The principles of financial strategy: value creation, risk-return optimization, time value of money, capital structure design, liquidity management, strategic alignment, and ethical governance provide a foundation for decision-making. They ensure that financial choices are not made in isolation, but as part of an integrated effort to achieve long-term competitive advantage. Chapter 3: Financial Analysis for Strategic Decision-Making. 3.1 Overview. Financial analysis is a cornerstone of strategic financial management. It enables decision-makers to evaluate the current financial health of an organization, compare performance against competitors, and make data-driven choices about investments, financing, and operations. Strategic financial analysis goes beyond simple ratio calculations. It considers industry dynamics, macroeconomic conditions, and the company's long-term goals. 3.2 Objectives of financial analysis. Strategic financial analysis serves several purposes. Performance measurement, determining how well the organization is meeting its financial objectives. Decision support, providing insights for capital allocation, risk management, and strategic planning. Early warning system, detecting financial distress or declining competitiveness before they become critical. Stakeholder communication, offering transparent data-driven narratives to investors, creditors, and regulators. 3.3 Key financial statements. A thorough financial analysis begins with understanding the three primary financial statements. Income statement measures profitability over a period, focusing on revenues, expenses, and net income. Balance sheet provides a snapshot of assets, liabilities, and shareholders' equity at a point in time. Cash flow statement tracks the flow of cash from operations, investing, and financing activities. Strategic decisions require integrating insights from all three statements rather than examining them in isolation. 3.4 Ratio analysis for strategic insight. Ratios transform raw financial data into meaningful indicators. The major categories include liquidity ratios, current ratio, quick ratio, assess short-term solvency. Leverage ratios, debt to equity, interest coverage, evaluate capital structure risk. Profitability ratios, net margin, ROA, measure efficiency and value creation. Efficiency ratios, inventory turnover, receivables turnover, gauge operational performance. Market ratios, PE ratio, market to book, reflect investor expectations. Strategic analysis uses these ratios to compare performance against competitors and identify strengths or weaknesses. 3.5 Trend and comparative analysis. Isolated figures have limited meaning. Strategic financial analysis uses horizontal analysis, comparing financial results across periods to identify growth patterns. Vertical analysis, expressing financial statement items as percentages, e.g., common size analysis. Benchmarking, comparing performance against industry averages or peer companies. These techniques help reveal structural changes in revenue mix, cost structure, and profitability. 3.6 Economic value added, EVA, and other value metrics. Traditional accounting profits do not always capture true economic performance. EVA and similar metrics adjust for the cost of capital. EVA formula: EVA equals NOPAT capital times WACC. Market value added, MVA, measures the difference between market value and invested capital. Free cash flow, FCF, focuses on cash available for distribution after investments. Such metrics are essential for assessing whether the company is generating wealth for shareholders. 3.7 Scenario and sensitivity analysis. Strategic decisions are made under uncertainty. Scenario analysis helps test assumptions. Best case, worst case scenarios explore possible extremes. Sensitivity analysis determines which variables have the greatest impact on outcomes, e.g., sales volume, interest rates. Monte Carlo simulation uses probability distributions to model a range of potential results. These tools enhance decision-making by accounting for volatility and risk. 3.8 Balanced scorecard and non-financial metrics. Financial metrics alone are not sufficient. The balanced scorecard integrates financial perspective, revenue growth ROI, customer perspective, market share, customer satisfaction, internal process perspective, operational efficiency, innovation, learning and growth perspective, employee development, knowledge management. Strategic financial management considers both financial and non-financial drivers of performance. 3.9 Limitations of financial analysis. While powerful, financial analysis has its constraints. Historical nature. Most data reflects past performance, not future prospects. Accounting policies. Results can be influenced by different accounting standards and assumptions. Qualitative factors. Leadership quality, brand strength, and innovation capacity may not appear in financial statements. Strategic managers must supplement financial analysis with qualitative insights. 3.10 Summary. Financial analysis provides the foundation for informed strategic decision-making. By combining ratio analysis, trend analysis, value metrics, and scenario planning, organizations can evaluate their performance and position themselves for sustainable growth. However, analysis should always be contextualized within the company's strategy and competitive environment. Chapter 4. Capital Budgeting and Strategic Planning. 4.1 Overview. Capital budgeting is the process of evaluating and selecting long-term investments that align with an organization's strategic objectives. It plays a crucial role in strategic financial management, as these decisions often involve significant capital outlays, long time horizons, and lasting implications for competitiveness. Strategic planning ensures that capital budgeting decisions are not made in isolation, but fit within the broader corporate mission, vision, and growth trajectory. 4.2 The role of capital budgeting in strategy. Capital budgeting connects strategy to action. Strategic alignment ensures investments support corporate priorities, e.g., market expansion, product innovation. Resource allocation directs scarce financial resources to the most value-creating opportunities. Risk management evaluates uncertainty and integrates risk mitigation into project selection. Without disciplined capital budgeting, companies risk underinvesting in critical initiatives or wasting resources on low-value projects. 4.3 The capital budgeting process. A systematic approach typically involves identification of opportunities, generating investment ideas from strategic planning sessions, market research, or innovation pipelines. Screening and preliminary evaluation, discarding projects that fail to meet basic strategic or financial criteria. Detailed financial analysis, applying quantitative tools such as NPV, IRR, and payback period. Risk assessment, performing sensitivity and scenario analysis to test robustness. Selection and approval, choosing projects that maximize value creation and fit strategic goals. Implementation, managing project execution and monitoring costs. Post-completion review, comparing actual performance to projections to improve future decisions. 4.4 Capital budgeting techniques. Net present value, NPV. Definition: present value of future cash inflows minus initial investment. Decision rule: accept projects with positive NPV. Strategic value captures the impact on shareholder wealth. Internal rate of return, IRR. Definition: discount rate that makes NPV equals 0. Decision rule: accept projects with IRR greater than the cost of capital. Considerations: may produce multiple values for non-conventional cash flows. Payback period. Definition: time required to recover initial investment. Use simple, but ignores cash flows beyond the payback period and time value of money. Profitability index, PI. Definition: ratio of present value of cash inflows to initial investment. Useful for ranking projects when capital is rationed. 4.5 Real options in capital budgeting. Traditional techniques may undervalue flexibility. Real options analysis incorporates strategic choices such as option to expand, scaling up operations if demand exceeds expectations. Option to delay, waiting for more information before committing capital. Option to abandon, terminating a project if it becomes unprofitable. These options add value by providing management flexibility under uncertainty. 4.6 Strategic portfolio management. Rather than evaluating projects in isolation, companies manage an investment portfolio. Balancing risk, mixing low-risk and high-risk projects. Diversification, investing across markets, products, or technologies. Resource optimization, allocating capital to projects with the highest strategic impact. Portfolio management ensures that the sum of projects supports corporate objectives and maintains financial resilience. 4.7 Common pitfalls in capital budgeting. Some challenges include over-optimistic projections, inflated revenue forecasts leading to poor decisions, ignoring strategic fit, selecting profitable projects that do not support long-term positioning, capital rationing issues, misallocating funds due to flawed prioritization, bias and politics, allowing internal power dynamics to influence project selection. Robust governance and transparent evaluation criteria help mitigate these issues. 4.8 Post-implementation review. Learning from completed projects strengthens future decision-making. Variance analysis, comparing actual cash flows to projections. Performance metrics, evaluating ROI, NPV, and strategic impact. Continuous improvement, updating forecasting models and assumptions. 4.9 Summary. Capital budgeting is the bridge between strategy formulation and execution. By using rigorous evaluation techniques, incorporating risk analysis, and managing an investment portfolio, companies can ensure that their capital allocation decisions support long-term value creation. Chapter 5. Risk and uncertainty in investment. 5.1 Overview. Risk and uncertainty are inherent in all investment decisions. While capital budgeting techniques such as NPV and IRR provide a baseline for decision-making, they rely on assumptions that may not hold true in the real world. Strategic financial managers must incorporate risk analysis to ensure that chosen projects remain viable under a range of possible future conditions. 5.2 Understanding risk versus uncertainty. Risk. Situations where the probability of outcomes can be estimated based on historical data or statistical models. Uncertainty. Situations where outcomes and probabilities are unknown or difficult to quantify. Managing both requires tools that account for variability, unexpected events, and changing market dynamics. 5.3 Types of investment risk. Strategic investment decisions are exposed to multiple types of risk. Market risk, price fluctuations, interest rate movements, and macroeconomic volatility. Credit risk, risk of counterparties defaulting on obligations. Operational risk, failures in processes, systems, or human factors. Regulatory and legal risk, changes in tax laws, compliance requirements, or government policies. Technological risk, obsolescence or disruption due to innovation. Identifying and categorizing these risks is the first step toward managing them effectively. 5.4 Sensitivity analysis. Sensitivity analysis tests how changes in key variables affect project outcomes. Single variable sensitivity, adjusting one variable, e.g. sales volume, while holding others constant. Multiple variable sensitivity, examining the combined effect of simultaneous changes. Critical variable identification, determining which assumptions have the largest impact on NPV or IRR. This approach helps managers focus on the most important drivers of value. 5.5 Scenario Analysis. Scenario analysis expands sensitivity analysis by exploring different coherent future states. Best case and worst case, establishing optimistic and pessimistic forecasts. Base case, using most likely assumptions as a reference point. Strategic scenarios, incorporating competitive actions, regulatory changes, and macroeconomic shocks. Scenario planning is especially valuable for industries subject to rapid change or disruption. 5.6 Monte Carlo Simulation. Monte Carlo simulation provides a probabilistic view of project outcomes. Process assigns probability distributions to uncertain variables, then runs thousands of simulations. Output produces a distribution of NPVs or IRRs rather than a single point estimate. Benefit offers a clearer understanding of potential upside and downside risks. This method supports more robust decision-making under uncertainty. 5.7 Decision trees and real options. Decision trees map out sequential decisions and possible outcomes, enabling visualization, understanding paths of action and corresponding payoffs. Risk-adjusted decision-making, incorporating probabilities and expected values. Integration with real options, highlighting flexibility to delay, expand, contract, or abandon projects based on new information. This approach blends financial modeling with strategic thinking. 5.8 Risk mitigation strategies. Once risks are identified and quantified, mitigation plans are developed. Diversification, spreading investments across products, markets, or geographies. Hedging, using derivatives such as futures, options, or swaps to lock in prices or interest rates. Contractual protections, including clauses in supplier or customer contracts to share or transfer risk. Contingency planning, setting aside reserves for unforeseen events. Effective risk management ensures that projects remain aligned with corporate risk appetite. 5.9 Integrating risk into capital budgeting. Risk-adjusted capital budgeting techniques include risk-adjusted discount rate (RADR), applying a higher discount rate to riskier projects. Certainty equivalent approach, adjusting expected cash flows downward to reflect risk. Risk-weighted portfolio view, considering how a project affects the risk profile of the overall investment portfolio. These methods ensure that risk is explicitly accounted for in investment decisions. 5.10 Summary. Managing risk and uncertainty is a critical component of strategic financial management. Techniques such as sensitivity analysis, scenario planning, Monte Carlo simulation, and decision trees provide insight into potential variability in outcomes. Coupled with risk mitigation strategies and risk-adjusted evaluation methods, these tools enable organizations to pursue opportunities confidently while safeguarding against potential losses. Chapter 6: Mergers, Acquisitions, and Divestitures. 6.1 Overview. Mergers, acquisitions, M&A, and divestitures are strategic tools that companies use to achieve growth, enter new markets, acquire technology, or optimize their portfolios. These transactions have significant financial implications and require careful strategic and financial planning to ensure they create long-term value for shareholders. 6.2 Strategic Objectives of M&A. Companies pursue M&A for several strategic reasons. Market expansion, entering new geographies or customer segments. Product or technology acquisition, gaining proprietary technologies or product lines. Synergies, reducing costs or increasing revenues through combined operations. Competitive advantage, strengthening market position and barriers to entry. Diversification, reducing exposure to a single market or product risk. A clear strategic rationale is critical for evaluating potential deals. 6.3 Valuation Techniques. Valuing a target company accurately is central to successful M&A. Discounted cash flow (DCF) projects future cash flows and discounts them using WACC. Comparable company analysis uses valuation multiples from similar publicly traded companies. Precedent transactions analyzes prices paid for similar companies in prior deals. Asset-based valuation determines value based on the company's net assets. Each method has strengths and limitations. Often multiple approaches are combined for a robust valuation. 6.4 Synergy Assessment. Synergies represent the additional value created by combining two firms. Cost synergies, reductions in operating expenses, headcount, or procurement costs. Revenue synergies, cross-selling products, expanding market reach, or leveraging brand value. Financial synergies, tax benefits, better access to capital, or improved cash flow management. Quantifying synergies is essential to justify the premium paid in an acquisition. 6.5 Deal Structuring and Financing. Effective deal structuring addresses payment method, financing, and risk allocation. Payment methods: cash, stock, or hybrid deals. Financing options: internal cash, debt financing, or equity issuance. Contingent considerations: earn-outs or performance-based payments. Risk allocation: addressing liabilities, warranties, or integration risks. The goal is to optimize value while managing exposure and maintaining strategic alignment. 6.6 Due diligence. Thorough due diligence ensures informed decision-making. Financial analysis: reviewing historical performance, projections, and accounting policies. Legal review: identifying regulatory, contractual, or litigation risks. Operational assessment: evaluating processes, human resources, and technology. Cultural fit: assessing organizational compatibility to ensure smooth integration. Due diligence reduces the likelihood of post-acquisition surprises and value erosion. 6.7 Divestitures and spin-offs. Divestitures involve selling or spinning off non-core assets or business units. Strategic focus: concentrating resources on core competencies. Capital reallocation: freeing funds for higher value investments. Performance improvement: streamlining operations and improving efficiency. Market signaling: communicating commitment to long-term strategy. Divestitures can enhance shareholder value if executed strategically. 6.8 Integration and post-merger management. Successful M&A requires effective integration. Operational integration: combining systems, processes, and teams. Cultural integration: aligning organizational values and management styles. Performance monitoring: tracking synergies, financial targets, and strategic goals. Change management: managing employee expectations and retaining key talent. Poor integration is a common reason why M&A fails to deliver expected value. 6.9 Common pitfalls in M&A. Overpaying for targets: paying more than the value justified by cash flows and synergies. Ignoring cultural differences: misalignment can lead to employee attrition and reduced productivity. Overestimating synergies: overly optimistic cost savings or revenue enhancements. Poor integration planning: lack of coordination during post-merger implementation. Mitigating these risks requires rigorous planning, valuation discipline, and active management. 6.10 Summary. Mergers, acquisitions, and divestitures are powerful strategic tools to achieve growth, enhance competitiveness, and optimize resources. Effective M&A requires strategic clarity, robust valuation, synergy assessment, careful deal structuring, thorough due diligence, and meticulous integration planning. When executed well, these transactions can create substantial long-term value for shareholders. Chapter 7. Cost of Capital and Capital Structure. 7.1 Overview. Capital structure decisions determining the optimal mix of debt and equity, are critical for strategic financial management. A firm's cost of capital directly influences investment decisions, valuation, and shareholder wealth. The goal is to minimize the weighted average cost of capital, WACC, while maintaining financial flexibility and managing risk. 7.2 Factors affecting capital structure. Several internal and external factors influence optimal capital structure. Business risk. Firms with stable cash flows can safely take on more debt. Financial flexibility. Ability to raise funds quickly under changing conditions. Tax considerations. Interest payments are tax deductible, favoring debt financing. Market conditions. Investor sentiment and credit availability affect borrowing costs. Growth opportunities. High-growth firms may prefer equity to preserve flexibility. Industry norms. Benchmarking against peer companies helps maintain competitive positioning. 7.3 Capital structure theories. Modigliani-Miller theorem, without taxes. In perfect markets, capital structure does not affect firm value. Provides a theoretical baseline. Real-world frictions like taxes, bankruptcy, and agency costs are ignored. Trade-off theory. Firms balance tax benefits of debt against bankruptcy costs. Optimal structure minimizes WACC and maximizes firm value. Pecking order theory. Firms prefer internal financing first, then debt, and issue equity as a last resort. Explains why profitable firms may carry little debt. Market timing theory. Firms issue equity when stock prices are high and repurchase when undervalued. Suggests capital structure is influenced by market conditions rather than optimality. 7.4 Leverage and financial risk. Leverage amplifies returns but also increases risk. Operating leverage, degree to which fixed costs exist in operations, affects sensitivity to sales changes. Financial leverage, use of debt in the capital structure, affects variability of EPS and ROE. Combined leverage, overall sensitivity of profits to sales and debt levels. Strategic financial management seeks a balance that enhances returns without exposing the firm to excessive risk. 7.5 Determining the optimal capital structure. Key steps include assessing business risk. Understand variability in operating cash flows. Estimating cost of debt and equity. Calculate WACC at different debt-equity ratios. Evaluating tax and bankruptcy implications. Consider interest deductibility and potential distress costs. Scenario analysis. Test how different structures perform under economic fluctuations. Benchmarking. Compare with industry standards and competitors. The optimal structure minimizes WACC while supporting strategic objectives and financial flexibility. 7.6 Dividend policy and capital structure. Capital structure decisions are closely linked to dividend policy. Residual dividend policy. Pay dividends from leftover earnings after funding profitable projects. Stability versus flexibility. High dividends may limit debt capacity. Retaining earnings can support growth. Signal to investors. Changes in capital structure or dividend policy convey information about financial health and strategy. Aligning dividends with financing strategy ensures consistency with shareholder value maximization. 7.7 Summary. Capital structure and cost of capital are central to strategic financial management. By understanding WACC, leverage, and financing options, firms can make informed decisions about how to fund investments, manage risk, and optimize shareholder value. The choice of debt and equity must consider business risk, tax implications, market conditions, and strategic growth opportunities. Chapter 8 Sources of Finance. 8.1 Overview. Effective strategic financial management requires access to a variety of funding sources. Selecting the right mix of debt, equity, and hybrid instruments ensures that organizations can finance growth initiatives, manage liquidity, and optimize their capital structure while minimizing costs and risks. 8.2 Equity financing. Equity represents ownership in a company and can be sourced through common stock, provides voting rights and potential dividends, attractive for long-term financing but dilutes ownership. Preferred stock, typically fixed dividends and no voting rights, balances cost and control. Private equity, investments from venture capitalists or private equity funds, often used for high growth or turnaround situations. Retained earnings, internal equity that avoids dilution but may limit flexibility if overutilized. Equity financing is generally more expensive than debt due to higher expected returns demanded by shareholders, but it reduces financial risk. 8.3 Debt financing. Debt provides capital in exchange for fixed interest payments and eventual principal repayment. Bank loans and lines of credit, flexible, commonly used for working capital or short-term needs. Corporate bonds, long-term debt with fixed or variable interest rates, accessible to larger companies. Lease financing, acquiring assets without large upfront costs, includes operating and finance leases. Syndicated loans, large-scale funding from a consortium of lenders. Debt financing benefits from tax-deductible interest but increases financial leverage and the risk of default. 8.4 Hybrid instruments. Hybrid instruments combine features of debt and equity. Convertible bonds, debt that can convert into equity, provides downside protection with potential upside. Mezzanine financing, subordinated debt with equity-like returns, used in leveraged buyouts and growth financing. Preferred equity with redemption features, flexible instruments bridging equity and debt. Hybrids can optimize capital structure by balancing cost, flexibility, and risk. 8.5 Short-term versus long-term financing. Short-term financing, typically for working capital needs, includes overdrafts, trade credit, and short-term loans. Long-term financing, used for capital expenditure, acquisitions, or strategic initiatives, includes bonds, term loans, and equity issuance. Strategic managers must align the duration of financing with the nature of the investment to avoid liquidity mismatches. 8.6 Factors influencing choice of finance. Several considerations guide financing decisions. Cost of capital, choosing the lowest cost source without compromising flexibility. Risk tolerance, balancing debt exposure against financial stability. Market conditions, interest rates, investor sentiment, and access to capital markets. Regulatory constraints, compliance with covenants, securities regulations, and tax rules. Strategic goals, supporting growth, acquisitions, or operational expansion. 8.7 Matching finance to investment. Strategic financial management emphasizes matching the financing instrument to the investment. Long-term projects with stable cash flows are suitable for debt. High-risk, innovative initiatives may require equity or hybrid instruments. Working capital needs are best served by short-term debt or internal funds. Proper alignment reduces financial stress and enhances project viability. 8.8 Summary. Understanding and selecting appropriate sources of finance is essential for executing strategic initiatives. Equity, debt, and hybrid instruments each have unique advantages, costs, and risks. By carefully matching financing choices to investment types, cash flow profiles, and strategic objectives, companies can maintain financial flexibility, optimize capital structure, and create long-term shareholder value. Chapter 9. Dividend Policy and Shareholder Value. 9.1 Overview. Dividend policy is a critical aspect of strategic financial management, as it determines how profits are distributed to shareholders versus reinvested in the business. Effective dividend strategies can influence investor perception, capital structure, and long-term value creation. 9.2 Objectives of dividend policy. The primary objectives include shareholder wealth maximization, balancing dividends and retained earnings to enhance firm value. Signaling, communicating financial health and confidence in future cash flows. Stability, providing predictable income streams to investors. Flexibility, maintaining sufficient funds for growth initiatives and unforeseen contingencies. 9.3 Dividend Relevance Theories. Walter's model suggests that dividend policy affects the value of the firm. Firms with high returns relative to the cost of capital should retain earnings to maximize value. Gordon's growth model, similar to Walter's model, emphasizes the role of dividends in shareholder wealth creation. Dividend growth positively impacts firm value if returns exceed cost of equity. Modigliani Miller, dividend or relevance theory. In perfect markets, dividend policy does not affect firm value. Real-world frictions, taxes, transaction costs, make dividends relevant in practice. 9.4 Types of dividend policies. Stable dividend policy, consistent dividends regardless of short-term earnings fluctuations. Residual dividend policy, dividends are paid from leftover earnings after funding profitable projects. Hybrid policy, combines stability with flexibility to adjust payouts based on earnings. Special dividends, one-time payouts from extraordinary profits or asset sales. Each approach has implications for investor expectations and corporate financing flexibility. 9.5 Dividend payout ratio and retention ratio. Dividend payout ratio, proportion of earnings distributed as dividends. Retention ratio, plowback ratio, portion of earnings retained for reinvestment. Strategic decisions must balance immediate shareholder returns with funding for growth and capital projects. 9.6 Impact on shareholder value. Dividend policy influences value through investor preference. Some investors favor income dividends, while others prefer capital gains. Market signaling. Dividend increases can signal strong cash flows, while cuts may indicate financial stress. Cost of capital. Retained earnings reduce the need for external financing, potentially lowering WACC. 9.7 Factors influencing dividend decisions. Profitability and cash flow, availability of sustainable earnings. Investment opportunities, need for reinvestment in high-return projects. Financial flexibility, ability to raise capital externally if dividends are high. Tax considerations, differential tax treatment of dividends versus capital gains. Regulatory constraints, restrictions on dividend payments in certain jurisdictions. 9.8 Dividend policy in practice. Companies often adopt pragmatic approaches. Establish a base dividend for stability. Adjust payouts according to earnings volatility and investment needs. Consider investor expectations and market trends. Strategic alignment ensures dividends support both shareholder satisfaction and long-term growth. 9.9 Summary. Dividend policy is a strategic decision that balances shareholder returns with reinvestment needs. By understanding theoretical frameworks, evaluating payout and retention ratios, and considering practical constraints, financial managers can design policies that enhance shareholder value, support growth, and maintain financial flexibility. Chapter 10. Managing Financial Risk. 10.1 Overview. Financial risk management is a core component of strategic financial management. It involves identifying, assessing, and mitigating risks that could adversely impact an organization's financial performance or strategic objectives. Effective risk management protects value, supports decision-making, and enhances resilience against unexpected events. 10.2 Types of financial risk. Market risk. Definition: exposure to fluctuations in market variables such as interest rates, foreign exchange rates, commodity prices, and equity prices. Examples: a rise in interest rates increases borrowing costs. Currency depreciation affects import-export revenues. Credit risk. Definition: risk of loss due to a counterparty's failure to meet contractual obligations. Examples: defaults on loans, trade receivables, or bond payments. Liquidity risk. Definition: inability to meet short-term obligations due to insufficient cash or liquid assets. Examples: difficulty in converting assets to cash quickly, funding gaps in operations. Operational risk. Definition: risk arising from internal processes, systems, people, or external events. Examples: fraud, system failures, supply chain disruptions. Regulatory and compliance risk. Definition: risk of financial loss due to non-compliance with laws or regulations. Examples: fines, penalties, or business restrictions. 10.3 Risk identification and assessment. Risk mapping. Listing potential risks and categorizing them by impact and likelihood. Quantitative assessment, using statistical models, stress testing, and scenario analysis. Qualitative assessment, expert judgment, historical experience, and industry benchmarks. A comprehensive assessment ensures that significant risks are prioritized and managed effectively. 10.4 Risk measurement techniques. Value at risk, VAR, estimates potential loss over a specified period at a given confidence level. Expected shortfall, conditional VAR, measures average loss in extreme scenarios beyond VAR. Stress testing, evaluates performance under extreme but plausible conditions. Credit scoring and ratings, assess creditworthiness of counterparties. Accurate measurement is essential for informed strategic decisions. 10.5 Risk mitigation strategies. Hedging. Derivatives, forwards, futures, options, and swaps to offset exposures. Natural hedges, matching cash flows in the same currency or interest rate profile. Diversification. Spreading investments across assets, sectors, or geographies to reduce concentration risk. Insurance. Transferring specific risks to insurance providers, e.g., property, liability, credit insurance. Risk transfer in contracts. Using contractual arrangements, guarantees, or outsourcing to allocate risk. Contingency planning. Establishing reserves, liquidity buffers, and alternative funding plans for unexpected events. 10.6 Enterprise Risk Management, ERM. ERM integrates risk management across the organization. Holistic approach, considers interdependencies among risks and aligns with corporate strategy. Governance, clear roles, responsibilities, and reporting structures. Risk appetite and tolerance, defines acceptable levels of exposure. Continuous monitoring, tracks emerging risks and adjusts strategies proactively. ERM supports strategic decision-making and long-term resilience. 10.7 Integrating risk management with strategy. Capital allocation, adjusting investment and financing decisions based on risk-return trade-offs. Performance measurement, incorporating risk-adjusted metrics like risk-adjusted ROI or EVA. Decision support, using risk insights to inform M&A, capital budgeting, and financing choices. Integrating risk management ensures that strategic goals are achievable without jeopardizing financial stability. 10.8 Summary. Managing financial risk is essential for sustainable value creation. By identifying, measuring, and mitigating market, credit, liquidity, operational, and regulatory risks, organizations protect their assets and strategic initiatives. Tools such as derivatives, diversification, insurance, and ERM frameworks enable proactive and integrated risk management. Chapter 11. Corporate Governance and Ethics. 11.1 Overview. Corporate governance and ethical practices are integral to strategic financial management. Good governance ensures accountability, transparency, and alignment of interests among shareholders, management, and other stakeholders. Ethical financial behavior builds trust, mitigates risks, and enhances long-term value creation. 11.2 Principles of Corporate Governance. Accountability. Management is accountable to the board and shareholders. Transparency. Accurate and timely disclosure of financial information. Fairness. Equal treatment of all shareholders, including minority stakeholders. Responsibility. compliance with laws, regulations, and fiduciary duties. Sustainability, incorporating environmental, social, and governance (ESG) considerations. These principles create a framework for decision-making that supports both ethical and strategic objectives. 11.3 Governance structures. Board of Directors. Composition. Independent and non-executive directors provide oversight. Committees, audit, compensation, risk, and nomination committees strengthen governance. Roles, setting strategy, monitoring performance, and ensuring accountability. Management oversight. CFO and finance team implement financial strategy within ethical and governance frameworks. Internal controls, policies and procedures to prevent fraud, errors, and mismanagement. Shareholder rights. Voting rights and participation in key decisions ensure alignment of interests. 11.4 Ethical considerations in financial management. Integrity, honesty in reporting and decision-making. Objectivity, avoiding conflicts of interest in financial judgments. Professional competence, maintaining knowledge and skills to perform responsibilities effectively. Confidentiality, protecting sensitive information. Compliance, adhering to laws, regulations, and professional standards. Ethical lapses can lead to financial penalties, reputational damage, and loss of shareholder confidence. 11.5 Governance and risk management. Good governance supports effective risk management. Oversight, boards monitor risk exposure and mitigation strategies. Accountability, management is held responsible for financial and operational risks. Transparency, disclosure of risks and risk management practices to stakeholders. Integration of governance and risk frameworks enhances strategic decision-making and resilience. 11.6 Corporate social responsibility, CSR and ESG. Strategic financial management increasingly incorporates CSR and ESG considerations. Environmental responsibility, sustainable use of resources and reducing carbon footprint. Social responsibility, fair labor practices, community engagement, and diversity. Governance, ethical leadership, anti-corruption measures, and transparency. Investors and stakeholders increasingly evaluate companies based on ESG performance, linking ethics to long-term financial success. 11.7 Challenges in governance and ethics. Conflicts of interest, balancing management incentives with shareholder expectations. Regulatory complexity, navigating diverse legal and compliance requirements. Cultural differences, ethical norms vary across regions and industries. Pressure for short-term results, market expectations can lead to compromises in governance or ethical standards. Robust governance structures, codes of conduct, and ethical training help mitigate these challenges. 11.8 Summary. Corporate governance and ethics are essential pillars of strategic financial management. By establishing clear governance structures, enforcing ethical practices, and integrating ESG considerations, organizations can enhance transparency, manage risks, and create sustainable value. Ethical governance aligns management decisions with the long-term interests of shareholders and other stakeholders. Chapter 12. International Financial Management. 12.1 Overview. International Financial Management, IFM, involves managing financial resources and risks in a global context. As companies expand across borders, they face additional complexities such as foreign exchange risk, political risk, and varying regulatory environments. Strategic IFM ensures that international operations contribute to long-term value creation, while mitigating risks unique to global markets. 12.2 Key Objectives of International Financial Management. Profit maximization, ensuring international operations enhance overall profitability. Risk management, identifying and mitigating currency, interest rate, and political risks. Liquidity management, maintaining cash flow efficiency across multiple countries. Cost of capital optimization. Accessing global capital markets to fund international operations effectively. Compliance. Adhering to international accounting standards, tax regulations, and trade laws. 12.3 Foreign exchange risk. Foreign exchange (FX) risk arises from fluctuations in currency values. Transaction exposure. Risk from obligations denominated in foreign currencies. Translation exposure. Impact of currency changes on consolidated financial statements. Economic exposure. Long-term impact on competitive position and cash flows due to exchange rate movements. Hedging techniques. Forward contracts, locking in exchange rates for future transactions. Futures contracts, standardized exchange contracts for hedging. Options, right to buy or sell currency at a predetermined rate. Natural hedges, matching revenues and costs in the same currency. 12.4 Political and economic risk. Political risk. Risk of government actions affecting operations, e.g., expropriation, nationalization, or policy changes. Economic risk. Macroeconomic factors such as inflation, interest rates, or trade restrictions impacting international operations. Mitigation strategies include political risk insurance, diversification, and strategic alliances. 12.5 International capital budgeting. Capital budgeting in a global context involves additional considerations. Currency conversion, estimating cash flows in local and reporting currencies. Country-specific discount rates, adjusting for country risk premiums. Tax and regulatory differences, accounting for withholding taxes, tariffs, and local regulations. Cross-border financing, sourcing funds from local and international markets. 12.6 Global financing options. International equity, listing on foreign stock exchanges or attracting global investors. Syndicated loans, borrowing from a consortium of international banks. Eurobonds, raising debt in a currency different from the country of issuance. Foreign direct investment (FDI), strategic ownership of assets abroad to support operations. Selecting the right financing option balances cost, risk, and strategic flexibility. 12.7 Managing cross-border cash flows. Effective cash management across countries ensures liquidity and efficiency. Cash pooling, centralized management of multiple accounts. Netting, offsetting receivables and payables across subsidiaries. Transfer pricing, aligning intercompany transactions with tax and regulatory compliance. 12.8 International taxation and regulatory compliance. Tax planning, optimizing global tax liabilities through legal structures and incentives. Transfer pricing compliance, adhering to local and international guidelines. Regulatory compliance, navigating multiple jurisdictions' rules for securities, reporting, and financial operations. Non-compliance can result in fines, reputational damage, and strategic setbacks. 12.9 Strategic considerations. Diversification, spreading operations across countries reduces dependence on a single market. Competitive positioning, leveraging international resources to gain cost or differentiation advantage. Global risk management, coordinating currency, political, and operational risk strategies. Strategic alignment ensures international operations contribute to long-term value creation. 12.10 Summary. International financial management involves managing currency, political, and economic risks while optimizing capital allocation, liquidity, and compliance in global markets. By employing hedging strategies, international capital budgeting, and effective financing techniques, companies can successfully navigate cross-border complexities and enhance shareholder value. Chapter 13. Strategic Financial Planning and Forecasting. 13.1 Overview. Strategic financial planning and forecasting are essential for aligning financial resources with long-term organizational goals. These processes provide a roadmap for achieving growth, managing risk, and ensuring optimal capital allocation. Effective planning anticipates future financial needs and allows companies to make proactive rather than reactive decisions. 13.2 Objectives of Strategic Financial Planning. Resource allocation. Ensuring that financial resources are directed to the most value-creating activities. Liquidity management. Maintaining sufficient cash flow to meet operational and strategic needs. Risk management. Identifying potential financial risks and developing mitigation strategies. Performance benchmarking. Setting targets for profitability, growth, and efficiency. Stakeholder communication. Providing transparent financial projections to investors, creditors, and management. 13.3 Components of Financial Planning. Revenue forecasting. Projecting sales based on market trends, historical data, and strategic initiatives. Cost and expense planning. Estimating operational, capital, and contingency costs. Capital expenditure planning. Prioritizing investment projects and evaluating funding needs. Working capital management. Forecasting receivables, payables, and inventory requirements. Profit planning. Setting targets for net income, margins, and return metrics. 13.4 Forecasting techniques. Quantitative methods. Time series analysis. Using historical patterns to predict future outcomes. Regression analysis. Evaluating relationships between financial variables to project results. Trend analysis. Assessing growth patterns over multiple periods. Qualitative methods. Delphi method. Aggregating expert opinions to forecast outcomes. Market research. Incorporating industry and competitor insights. Scenario planning. Evaluating multiple potential futures to guide decision-making. Combining quantitative and qualitative methods enhances forecast accuracy and strategic relevance. 13.5 Budgeting and Financial Models. Master budget. Comprehensive financial plan covering revenues, expenses, and capital requirements. Flexible budget. Adjusts projections based on actual activity levels. Zero-based budgeting. Requires justification for all expenses, promoting efficiency. Financial modeling. Scenario-based models to evaluate the impact of strategic decisions on cash flows, profits, and valuation. Robust budgeting ensures alignment between financial resources and strategic objectives. 13.6 Cash flow forecasting. Operating cash flow forecast predicts cash from core operations. Investing cash flow forecast projects expenditures and proceeds from capital investments. Financing cash flow forecast plans debt and equity funding, dividend payments, and other financing activities. Accurate cash flow forecasting supports liquidity management and risk mitigation. 13.7 Strategic alignment. Linked to corporate strategy. Financial plans should support strategic goals, including growth, market expansion, and innovation. Performance metrics. Use KPIs and financial ratios to monitor progress. Integration with risk management. Incorporate risk-adjusted assumptions and contingency plans. Ensuring strategic alignment enables financial planning to guide sustainable value creation. 13.8 Monitoring and review. Variance analysis. Comparing actual results against forecasts to identify deviations. Rolling forecasts. Updating projections regularly to reflect changing conditions. Continuous improvement. Refining assumptions, models, and processes based on lessons learned. Ongoing monitoring ensures financial plans remain relevant and effective. 13.9 Summary. Strategic financial planning and forecasting provide the foundation for informed decision-making, resource allocation, and risk management. By integrating quantitative and qualitative forecasting, robust budgeting, and cash flow planning, organizations can align financial resources with strategic objectives and maintain long-term financial stability. Chapter 14. Performance Measurement and Management. 14.1 Overview. Performance measurement and management are vital components of strategic financial management. By tracking and analyzing key financial and operational metrics, organizations can evaluate progress toward strategic objectives, identify areas for improvement, and make informed decisions that enhance value creation. 14.2 Objectives of Performance Measurement. Strategic alignment. Ensure operations and financial outcomes support long-term goals. Accountability. Hold management and departments responsible for results. Continuous improvement. Identify performance gaps and implement corrective actions. Resource optimization. Allocate resources to high-performing areas and projects. Investor communication. Provide transparent insights into organizational performance. 14.3 Financial Performance Metrics. Profitability metrics, net profit margin, operating margin, return on assets, ROA, and return on equity, ROE. Liquidity metrics, current ratio, quick ratio, and cash conversion cycle. Leverage metrics, debt-to-equity ratio, interest coverage ratio. Efficiency metrics, inventory turnover, receivables turnover, asset utilization. Value-based metrics, economic value added EVA, market value added MVA, and free cash flow FCF. Financial metrics provide quantitative evidence of how well the organization is achieving its objectives. 14.4 Non-financial performance metrics. Customer metrics, satisfaction, retention, market share. Internal process metrics, operational efficiency, quality, and innovation. Learning and growth metrics, employee engagement, skills development, knowledge management. Non-financial metrics complement financial indicators and provide a holistic view of performance. 14.5 Balanced Scorecard Approach. The balanced scorecard integrates financial and non-financial metrics across 4 perspectives. Financial perspective measures value creation and financial health. Customer perspective tracks market satisfaction and loyalty. Internal process perspective evaluates operational efficiency and innovation. Learning and growth perspective focuses on employee development and knowledge assets. This approach aligns performance measurement with strategy, ensuring a balanced view of organizational success. 14.6 Benchmarking. Internal benchmarking, comparing performance across departments or business units. External benchmarking, comparing against industry peers or best practices. Trend analysis, evaluating performance over time to identify patterns. Benchmarking highlights areas of strength and weakness, enabling targeted improvements. 14.7 Key Performance Indicators, KPIs. KPIs are quantifiable measures that track progress toward strategic objectives. Should be SMART, specific, measurable, achievable, relevant, and time-bound. Examples include revenue growth rate, customer acquisition cost, and project ROI. KPIs provide actionable insights and drive decision-making at all levels of the organization. 14.8 Performance Management Cycle. Planning, set objectives, targets, and KPIs aligned with strategy. Monitoring, track performance using real-time data and reporting systems. Analysis, compare results against benchmarks and expectations. Action, implement corrective measures or strategic adjustments. Review, evaluate effectiveness and refine goals for the next cycle. This iterative process ensures continuous alignment with strategic goals. 14.9 Challenges in performance measurement. Data quality. Inaccurate or incomplete data can mislead decision-making. Overemphasis on financial metrics. Ignoring non-financial indicators can overlook key drivers of value. Misaligned KPIs. Metrics not tied to strategy can incentivize undesired behavior. Complexity. Too many metrics can dilute focus and hinder decision-making. Addressing these challenges requires thoughtful metric selection, integrated reporting systems, and strategic alignment. 14.10 Summary. Performance measurement and management enable organizations to monitor progress, optimize resources, and ensure strategic objectives are met. By combining financial and non-financial metrics, leveraging balanced scorecard and KPIs, and implementing a continuous performance management cycle, companies can drive sustainable value creation. Chapter 15: Financial Technology and Innovation. 15.1 Overview. Financial technology, FinTech, and innovation are reshaping strategic financial management by enhancing efficiency, accuracy, and decision-making capabilities. From blockchain and artificial intelligence to digital payments and advanced analytics, FinTech provides tools that allow organizations to manage resources, risks, and strategy more effectively. 15.2 Key Areas of Financial Technology. Digital payments in banking. Mobile wallets, peer-to-peer payments, and online banking streamline cash management and customer transactions. Blockchain and distributed ledger technology enhances transparency, security, and efficiency in transactions, contracts, and record-keeping. Artificial intelligence, AI, and machine learning supports predictive analytics, fraud detection, credit scoring, and financial modeling. Robotic process automation, RPA, automates repetitive tasks such as invoice processing, reconciliation, and reporting. Cloud computing and big data provides scalable infrastructure for storing and analyzing large volumes of financial data. 15.3 FinTech in strategic financial management. Enhanced forecasting. AI and predictive analytics improve accuracy of financial projections and scenario modeling. Risk management. Real-time monitoring and data-driven insights help manage market, credit, and operational risks. Cost efficiency. Automation reduces manual effort, errors, and operational costs. Capital allocation. Advanced analytics support more informed investment and resource allocation decisions. Financial inclusion. Digital platforms enable access to financing and payment systems in underserved markets. 15.4 Blockchain applications. Smart contracts automate contract execution, ensuring compliance and reducing disputes. Secure payments lower transaction costs and improve speed of cross-border payments. Transparent record keeping. Immutable ledgers enhance auditability and regulatory compliance. Blockchain adoption strengthens strategic trust and operational efficiency. 15.5 Artificial intelligence and analytics. Predictive analytics forecast revenue, expenses, and cash flows with higher precision. Fraud detection identify suspicious transactions and mitigate financial losses. Credit risk assessment evaluate borrower risk using alternative data sources and AI models. Portfolio optimization support asset allocation and risk-return analysis in investment decisions. AI-driven insights allow for more agile and data-informed strategic choices. 15.6 Digital transformation in finance. ERP and financial systems integrate financial processes across departments for real-time visibility. Cloud-based reporting access financial data anytime, improving decision speed. Collaboration tools enhance coordination across finance teams and stakeholders. Digital transformation ensures that financial operations support agile and strategic decision-making. 15.7 Regulatory and security considerations. Cybersecurity protect sensitive financial data from breaches and cyber attacks. Compliance ensure adherence to evolving financial regulations and standards. Data privacy implement robust data governance and privacy policies. Balancing innovation with compliance and security is critical for sustainable adoption. 15.8 Challenges in FinTech adoption. Integration complexity. Combining new technology with legacy systems can be difficult. Skill gaps require skilled personnel to manage advanced technologies. Cost of implementation. High upfront investment in technology infrastructure. Regulatory uncertainty. Rapid innovation may outpace existing regulations. Addressing these challenges ensures successful implementation and value creation. 15.9 Summary. Financial technology and innovation are transforming strategic financial management by improving efficiency, enhancing decision-making, and enabling better risk management. By leveraging AI, blockchain, RPA, digital payments, and advanced analytics, organizations can gain a competitive edge while ensuring transparency, compliance, and agility. Chapter 16. Strategic Financial Decision-Making in Practice. 16.1 Overview. Strategic financial decision-making in practice involves applying principles, tools, and frameworks from prior chapters to real-world corporate situations. It integrates financial analysis, risk management, planning, and innovation to guide decisions that maximize shareholder value and support long-term strategic objectives. 16.2 Decision-Making Framework. A structured approach to strategic financial decisions includes: define objectives, align financial decisions with corporate strategy. Data collection and analysis, use financial statements, market data, and forecasting models. Risk assessment, identify market, credit, operational, and strategic risks. Option evaluation, compare alternatives using NPV, IRR, scenario analysis, and real options. Decision implementation, execute with clear responsibilities and timelines. Monitoring and review, evaluate outcomes, learn from results, and adjust future decisions. 16.3 Capital Budgeting in Practice. Evaluate investment opportunities using NPV, IRR, PI, and payback period. Incorporate risk through sensitivity analysis, scenario planning, and Monte Carlo simulation. Consider strategic fit and portfolio impact when selecting projects. Example: a multinational company deciding to invest in a new manufacturing facility evaluates projected cash flows, currency exposure, and strategic positioning before approval. 16.4 Mergers and Acquisitions. Target selection. Align with strategic goals such as market expansion or technology acquisition. Valuation and due diligence. Use DCF, comparable company analysis, and thorough risk assessment. Integration planning. Address operational, cultural, and financial integration. Example: acquisition of a tech startup to gain access to innovative AI technology, with valuation incorporating projected synergies and potential risks. 16.5 Financing decisions. Determine the optimal mix of debt, equity, and hybrid instruments. Evaluate cost of capital, financial risk, and flexibility requirements. Align financing with capital budgeting and strategic investment plans. Example: financing an international expansion through a combination of retained earnings, bank loans, and issuance of Eurobonds to minimize WACC and currency risk. 16.6 Risk Management Applications. Implement enterprise risk management to assess and mitigate financial, operational, and strategic risks. Use derivatives, diversification, and insurance to hedge exposures. Monitor risks continuously and adjust strategies proactively. Example: a corporation hedges foreign currency risk using forward contracts and options to protect profits from exchange rate volatility. 16.7 Performance monitoring and strategic adjustments. Set KPIs and balance scorecards to track progress. Conduct variance analysis to compare actual versus planned outcomes. Make adjustments to capital allocation, financing, or operational strategy based on performance insights. Example: quarterly review of a product line's ROI leads to reallocating resources to higher performing segments. 16.8 Integration of FinTech solutions. Leverage AI, blockchain, and automation to enhance data accuracy, forecasting, and decision-making. Employ advanced analytics to identify trends, optimize cash flows, and improve investment evaluation. Example: using AI-driven predictive models for inventory management and capital budgeting decisions. 16.9 Key takeaways. Strategic financial decisions require a balance between quantitative analysis and strategic alignment. Risk assessment, performance measurement, and technology integration enhance decision quality. Continuous monitoring, learning, and flexibility are essential for long-term value creation. 16.10 Summary. Practical strategic financial management synthesizes principles from capital budgeting, risk management, financing, M&A, performance measurement, and technological innovation. By applying structured frameworks, robust analysis, and proactive monitoring, organizations can make informed decisions that drive growth, manage risks, and optimize shareholder value. Chapter 17. Emerging Trends in Strategic Financial Management. 17.1 Overview. Strategic financial management is continuously evolving due to technological advancements, regulatory changes, globalization, and shifts in investor expectations. Staying ahead of emerging trends allows organizations to maintain competitiveness, optimize financial performance, and create long-term shareholder value. 17.2 FinTech and Digital Transformation. Artificial intelligence, AI, and machine learning enhances predictive analytics, risk assessment, and investment decision-making. Blockchain and smart contracts improves transparency, security, and efficiency in transactions. Robotic process automation, RPA, automates repetitive tasks, reducing errors and operational costs. Digital payments and open banking facilitates faster, more secure, and integrated financial operations. Digital transformation continues to shape strategic financial management by enabling real-time insights and process optimization. 17.3 Sustainability and ESG integration. Environmental, social, and governance (ESG) criteria increasingly incorporated into investment decisions and corporate strategies. Green financing, raising capital through sustainability-linked bonds and loans. Impact investing, targeting projects that deliver social or environmental impact alongside financial returns. Integrating ESG into strategic financial management is no longer optional. It drives long-term value creation and stakeholder trust. 17.4 Data analytics and big data. Advanced analytics supports scenario modeling, predictive forecasting, and risk management. Real-time reporting enables timely decisions based on current financial and operational data. Data-driven strategy leverages insights to optimize capital allocation, cost structures, and investment strategies. Big data analytics strengthens decision-making capabilities and enhances strategic agility. 17.5 Globalization and cross-border finance. Emerging market opportunities, expanding into new geographies to diversify revenue streams. Currency and political risk management, utilizing derivatives and strategic hedging to mitigate exposure. International capital markets, accessing global debt and equity funding at competitive costs. Globalization requires strategic financial managers to consider multi-jurisdictional challenges and opportunities. 17.6 Cybersecurity and financial risk management. Cyber threats, increasing dependence on digital systems heightens the risk of breaches. Integrated risk management, combining cyber risk with traditional financial, operational, and market risks. Compliance with data regulations, adhering to GDPR, CCPA, and other international frameworks. A proactive approach to cybersecurity ensures financial integrity and stakeholder confidence. 17.7 Agile and adaptive financial strategies. Scenario planning and stress testing, preparing for economic volatility and disruptive events. Rolling forecasts, continuously updating financial projections to respond to changing conditions. Flexible capital allocation, adjusting investment priorities based on evolving strategic goals. Agility allows organizations to navigate uncertainty and capitalize on emerging opportunities. 17.8 Artificial intelligence in strategic decision-making. Cognitive finance systems, AI systems that learn from historical data to recommend financial strategies. Predictive risk analytics, identifying emerging financial risks before they materialize. Portfolio optimization, using AI to maximize returns while minimizing risk exposure. AI-driven decision-making enhances precision, speed, and effectiveness in strategic financial management. 17.9 Regulatory and compliance trends. Evolving financial regulations, adapting to changes in accounting standards, tax rules, and international compliance requirements. Sustainable reporting standards, adoption of frameworks such as TCFD and SASB for ESG reporting. Enhanced transparency requirements, increasing disclosure obligations for investors and stakeholders. Compliance with emerging regulations ensures legal adherence and strengthens corporate reputation. 17.10 Summary. Emerging trends in strategic financial management, including FinTech adoption, ESG integration, big data analytics, globalization, cybersecurity, and agile strategies, are transforming how organizations manage resources, risks, and value creation. Staying informed and adaptable allows financial managers to leverage these trends, drive innovation, and maintain a competitive advantage. Chapter 18, Conclusion and Future Outlook. 18.1 Overview. This final chapter synthesizes the key principles, tools, and strategies covered throughout the book, emphasizing the importance of integrating strategic financial management into organizational decision-making. It also highlights future directions that will continue to shape the field, ensuring organizations remain competitive and resilient. 18.2 Key Insights from the book. Strategic integration. Financial management is most effective when aligned with corporate strategy, enabling informed investment, financing, and risk decisions. Capital structure optimization. Balancing debt, equity, and hybrid instruments is essential for minimizing WACC and maintaining financial flexibility. Risk management. Identifying, measuring, and mitigating financial, operational, and strategic risks protects value and supports decision-making. Performance measurement. Combining financial and non-financial metrics, KPIs, and balanced scorecards ensures accountability, continuous improvement, and alignment with strategic objectives. Technological innovation. FinTech, AI, blockchain, and analytics transform financial processes, forecasting, and decision-making. Global considerations. International operations require careful attention to currency, political, regulatory, and market risks. Governance and ethics. Strong corporate governance and ethical practices are foundational to sustainable financial management and stakeholder trust. Emerging trends. ESG integration, agile financial strategies, cybersecurity, and data-driven decision-making are reshaping the future of strategic finance. 18.3 Future Outlook. Technological advancements. Continued adoption of AI, machine learning, and blockchain will drive efficiency, transparency, and predictive capabilities in financial management. Automation and digital platforms will enable real-time reporting and strategic agility. Sustainability and ESG focus. Investors and stakeholders increasingly demand ESG-aligned strategies. Sustainable finance, impact investing, and green bonds will become central to corporate financial strategy. Globalization and geopolitical dynamics. International expansion will require sophisticated risk management and currency strategies. Organizations will need adaptive financial strategies to navigate geopolitical uncertainty and global market fluctuations. Data-driven decision-making. Advanced analytics, big data, and cognitive systems will enhance capital allocation, risk assessment, and strategic forecasting. Integration of real-time data and predictive modeling will improve responsiveness to market changes. Agile and resilient financial strategies. Scenario planning, rolling forecasts, and flexible capital allocation will become standard practices. Resilience in financial planning will enable organizations to withstand disruptions and capitalize on opportunities. 18.4 Final Thoughts. Strategic financial management is both an art and a science, requiring rigorous analysis, ethical judgment, and alignment with corporate strategy. Organizations that effectively integrate financial planning, risk management, performance measurement, and technological innovation will be well positioned to create sustainable value in an increasingly complex and dynamic environment. By embracing emerging trends, fostering ethical practices, and maintaining strategic focus, financial managers can ensure long-term organizational success and shareholder confidence. This concludes the comprehensive guide on strategic financial management. The concepts and frameworks presented throughout this book serve as a roadmap for financial leaders to make informed, strategic, and value-enhancing decisions.